On a typical Monday, the intersection of 49th Street and 7th Avenue is the heart of global commerce. But on September 15, 2008, it became a crime scene of sorts, the site of the largest corporate failure in human history. When Lehman Brothers filed for Chapter 11 bankruptcy, they didn't just close a bank, they pulled the rug out from under the global economy. $639 billion in assets vanished into a legal vacuum. Within hours, the Dow Jones plummeted 500 points, and the Lehman shock began to ripple from New York to London, Tokyo, and beyond. To understand how a 158-year-old institution collapsed in a single weekend, we have to look at the decade where they stopped being a bank and started being a gambler. In the late 90s, Lehman Brothers made a strategic pivot. They weren't content just advising on mergers, they wanted to own the debt. They began buying up subprime lenders like BNC Mortgage and Aurora Loan Services. By 2006, Lehman was a factory. They would issue the loans to risky borrowers, bundle those loans into complex securities, and sell them to investors worldwide. They were the biggest player in the mortgage-backed security market. But there was a catch. They were leveraged to the hilt. By 2007, Lehman's leverage ratio hit 31-1. For every $31 they moved, they only actually owned $1 in capital. They were essentially a $600 billion house of cards. If the value of their real estate holdings dropped by just 3.3%, the entire firm would be insolvent. As the housing market began to cool in 2007, Lehman's leadership, led by CEO Richard Fuld, faced a terrifying reality. They couldn't sell the toxic assets on the books. To hide the mounting debt from investors and regulators, they allegedly employed a controversial accounting maneuver known as Repo 105. Near the end of each quarter, Lehman would sell billions in assets to banks in the Cayman Islands with a promise to buy them back days later. This allowed them to temporarily wipe up to $50 billion in debt off their balance sheet, making the firm look much healthier than it actually was. But the market wasn't fooled for long. By mid-2008, short sellers were circling, and the firm's credit rating was under threat of a catastrophic downgrade. The first week of September brought total panic. Talks with the Korea Development Bank collapsed, and Lehman's stock price went into a free fall. On Friday, September 12th, the Federal Reserve Bank of New York became the war room. Secretary Henry Paulson issued a stern ultimatum: no taxpayer money. The government had already bailed out Bear Stearns months earlier and taken over Fannie Mae and Freddie Mac. They wanted the private sector to save Lehman. Two potential buyers emerged: Bank of America and Barclays. But as the weekend progressed, Bank of America realized the toxic holes in Lehman's books were too deep. They pivoted and bought Merrill Lynch instead. That left Barclays. A deal was ready, the contracts were on the table, until the British government stepped in. The UK's Financial Services Authority refused to allow the deal without a shareholder vote, which would take weeks. Barclays pulled out. Lehman was alone. Sunday afternoon was the end of the road. At 7:45, 7th Avenue, the mood was funereal. While the board prepared the bankruptcy filing, employees, many of whom had their entire life savings in Lehman stock, rushed to the office to pack their belongings. While the world waited for the filing, controversy brewed internally. Neuberger Berman, a Lehman subsidiary, suggested that top executives forego their multimillion-dollar bonuses to show accountability. The suggestion was not just rejected, it was met with an apology to the executive committee for their embarrassment of even suggesting it. At 1:45 a.m., just hours before the markets opened, the paperwork was filed. The giant had fallen. The fallout was immediate. The bankruptcy caused a general financial panic. Money market funds broke the buck, interbank lending froze, and the global economy ground to a halt. This single event necessitated the $700 billion top bailout just to keep the rest of the world's banks from following Lehman into the abyss. Richard Fuld later faced a grueling congressional hearing, where he was grilled on the $300 million he had taken in pay while the firm headed for a cliff. Today, Lehman Brothers is a ghost. Its North American assets were sold to Barclays for a fraction of their worth, and its European and Asian divisions were absorbed by Nomura. The bankruptcy proceedings lasted over 14 years, ending finally in 2022. It remains the ultimate warning of what happens when a firm becomes too big to fail, yet finds itself with no one left to save it.